Welcome to the last Shadow MPC of 2020, which is organised between Darlington Building Society and the Northern Echo. We gather together people of different sectors in the economy in the North East. We ask them what they think about the economy and how it's going, and then what they would do if they were on the real MPC that's run by the Bank of England. And later this week we'll decide whether interest rates stay the same, go up, go down, if that's possible, with negative interest rates still just a little bit of a possibility, and see what they feel about the way the bank would affect the monetary supply of the UK. Let's start with the organisation that sponsors this and has been doing so for several years. Let's talk to Chris White from Darlington Building Society. Chris, thank you for continuing to sponsor this organisation of people from the North East in the pandemic. We're doing it slightly differently. Tell us what your take is on the way your world works and the economy.
Morning, everybody. Thank you very much, Graham. Yes, as you say, I'm the finance director at Darlington Building Society, and quite happy to give you a little bit of an update on the environment in which our sector is operating at the moment. I guess primarily we are a mortgage lender, and obviously we also take in savings from people across our region as well. The mortgage market, I guess, has reacted in the second half of 2020 in ways that not a lot of people expected, in so much as obviously I think at the start of the year when the global pandemic hit, we were expecting housing transactions to be probably a record low at the moment. And in actual fact, we're seeing exactly the opposite. We're seeing a little bit of a mini housing boom at the moment. And certainly our pipeline, as we call it internally, the number of mortgage transactions we're currently dealing with is actually a record high for us as an organisation at the moment, which is great news for us, and I guess it's great news obviously for our customers being able to move home at a time where we thought that might not be possible. So that's been really strong, and I think is really encouraging for us. But I guess as we look forward, we do have concerns around how that pans out in 2021. I guess there's a couple of factors, such as the end of the stamp duty initiative, and end of the Help to Buy initiative as well, that may result in a change in the market, I guess, in the first quarter of next year. And I guess we do expect to think there to be a bit of a cooling off at that period and the number of transactions reduce. That being said, I guess we have seen that the demand-supply relationship of housing in the UK continues to be really strong at the moment. So we are hopeful that the transactions will cool, shall we say, in the first half of the year, but maybe return to more normal levels that we'd have seen maybe last year as a comparison. We as an organisation, I think, have done a lot in 2020 to try and support some of our members. I'm sure everyone's aware of the payment holiday initiative that was introduced by the government, and we've helped a lot of our members with that in the year and being able to people take a holiday from their mortgage commitments. And in actual fact, I think that's worked well for everybody concerned, because it's obviously given breathing room for some members, but realistically we've actually seen that the vast majority of those consumers have now returned to full payment, as it were, which is really good.
That is good.
Like I say, the other part of our business is obviously savings, and we've seen that being remarkably resilient as well. I think through 2020, whether it's been thrust upon us or by people choosing to save more, obviously people's options to spend money have been more limited in certain periods of 2020, and we have seen people saving with us more, which is also really encouraging. So I think that's us as a business. I guess more general. Go on.
You obviously feel that you're ending the year stronger even than when you began it, and certainly stronger than expectations when the pandemic started.
Yes, no, Graham, I'm quite happy to put my hand up and say I was not one of the people that expected a pandemic to result in a housing boom. Not something that we were putting into our forecasts, I guess in March, April time earlier this year, when we were looking at what we thought the consequences of the pandemic might be for us as a business and for the housing and the whole sector. I guess at that stage we were quite happy to say relatively pessimistic, should we say, at that stage. And I guess when we look back at those plans, we're outperforming them quite significantly at this point, which is obviously great news.
Okay, well, Chris, if you don't mind, I'm going to talk to our other sponsor and organiser of this Shadow MPC, and that is the Northern Echo. In this case, it's we're talking to David Coates, who's the Managing Director of Newsquest in the North. David, how have advertising streams been holding up? How do you see the economy?
My name's David Coates. I'm the Managing Director for Newsquest Media Group North. We publish local newspapers and news websites across the country, and I'm responsible for those in the North. We saw a unusual impact from the COVID situation. Obviously, audiences to our websites increased dramatically with people within the communities wanting to know what's going on in their local areas and understand the impact for them and their families and the community. And our audiences, our digital audiences, practically doubled. Our print audiences have remained pretty strong throughout the pandemic period as well. So from an appetite for local news, there was a significant increase. However, in the advertising markets, initially we saw a real softening of the digital advertising yields that were achieved. So whilst our audience practically doubled, the yields, the average revenue that we get per 1,000 impressions on our websites declined. But overall, digital advertising revenues have done reasonably well. Print advertising revenues have held up reasonably okay as well. We saw a big impact on retail and motors. Those industries were affected by the lockdown situation. Our operations in Cumbria and in parts of Yorkshire were also impacted in the leisure and entertainment sectors as well, which effectively just shut down. So it has been very difficult. We've had to do a certain amount of restructuring ourselves to try and offset the reduced advertising incomes. But overall, the impact has been supported by the government advertising campaign that's being featured across our sites and in our print products. And also the government's furlough schemes helped offset the costs where we've had to take advantage of the furlough scheme because, say, sectors of our business were effectively closed down by the COVID situation.
And it's clear, I suppose, there's an appetite for local news. So when business gets back to near normal, if there's a vaccine, then there is a V-shaped recovery in the shape of a V for vaccine, then they will be able to get in to advertise with you and reach more people. And people are very interested in how the pandemic is panning out locally.
Yeah, we hope so. And there's been a big push in terms of supporting local shops. We've run campaigns to try and encourage people to shop locally for many years. And obviously through the pandemic period, that's been really, really important. And people have responded really positively. So we are seeing support for local businesses from communities, which I think is to be encouraged. We feel a bit more confident about next year. I think that we could see a really strong bounce back in the economy. Because I think there'll be pent-up demand, particularly in the leisure and ent sector. I think people are keen to get out there and enjoy themselves, and we should see some improvements filtering through that. So it's cautious optimism for next year, Graham.
That's good. That's good. Well, thanks, David. Let's talk to our next contributor, who's Catriona Lingwood from Constructing Excellence North East. Catriona, we heard at the very beginning mortgage approvals going up and a mini housing boom going on. How's that affecting your members?
Well, the thing is, though, I think it's different parts of the industry or different parts of the sector experiencing different things at the moment. I think, obviously, infrastructure is one of the areas that's actually seen growth as well as the housing sector. So I think that they've actually had a now beyond the point of recovery from the start of the year. So I think that's all good news. There was a 1% sort of growth in the construction output for October, which was actually the smallest growth for the half year. I think the fears are going towards a no-deal Brexit, and the problem they've got is obtaining goods from abroad, because obviously UK builders are heavily reliant on materials from the EU. And I think that has shown a lot of concern, considering there's been a lack of materials throughout the sort of like the last few months, going back to the start of the pandemic when it hit quite badly in March. So I think that there's a few issues with regard to what's going to happen going forward. And it's not just obviously COVID that's causing the issue now. It's what's going to happen with the sort of like whether we get a deal or we actually end the year with a no deal, and how it then progresses through 2021. Obviously, the spending review, we've got they've just launched the spending review at the end of November. It's very similar to the National Infrastructure Strategy that was brought out in 2018. However, they're looking at the public sector building fairer, faster and greener. There's a 10-point plan that they brought out, looking at obviously towards the UK's net zero emissions target of 2050. And finally, I just want to say about the talent retention scheme for the construction sector. Obviously, that's something that was brought out by the Construction Leadership Council. It's had a tremendous amount of activity going on, and the amounts of savings that they've managed to do from the reduction in recruitment costs has looked at round about between $250,000 and $500,000 so far, which is quite a significant amount of people moving jobs and getting back into work.
That's great news. Thanks, Catriona. Let's move to our next contributor. Let's talk to Jonathan Lamb from Entrepreneurs Forum. Jonathan, you have over 300 members who own businesses. What's their point of view at this point in the economy?
I mean, the members in the northeast of England, they are, I guess you would say, sort of stereotypically entrepreneurial. They tend to be pretty ambitious and actually positive about the future, and that's no different for 2021. So they themselves have, however, sort of sometimes deferred investment decisions and growth plans, and partially sometimes because their marketplaces about their key clients have deferred plans. But there's a sense right across the sectors actually that there's a lot of pent-up demand, and that we don't really want to do anything at the moment to scare any of the horses, whether that's consumer demand or B2B demand. But there are definitely a sort of a queuing pattern of investment in those businesses that they're hoping to be able to push the button on in quarter four. No guarantees of that, but anything that would sort of make people cautious about those decisions, I guess, wouldn't go down too well with the entrepreneurs. And it is across sector. I mean, clearly the social distancing has a sort of disproportionate effect on some of the members' industries, and I think, as other people have mentioned, potentially those restrictions changing in and around about the sort of springtime will make a massive difference, not just in consumer confidence, but the knock-on effect in other industries as well.
Thanks, Jonathan. Chris McDonald from Material Processing Institute. You're obviously in the heavy industry area of Teesside and Tees Valley. What do you think about how the economy is going?
Thank you, Graham. So yes, at the Institute, we develop new technologies, primarily for, as you say, for heavy industry, for the metal sector. But I also speak as the chair of the UK Metals Council as well, which is the sector council for the industry across the whole of the UK. And talking to members of companies large and small in the metal sector, I think that there are a couple of major concerns in terms of forward outlook, both arising from COVID and from Brexit. So from a COVID perspective, many companies in the sector have experienced a big shortfall in activity in the last year, and consequently they've increased their debt. So liquidity is a bit of an issue going into the new year. And then whatever happens as a result of Brexit, there'll be a requirement generally for these companies to increase their working capital, simply because trade will be more difficult. And so, generally I'd be advising, well, look, to help these companies out, then perhaps a bit of a reduction in interest rates would be sensible. And it would also give us a boost to exports as we leave the EU as well, and help our international competitiveness. But we do know that tariffs will come online, and that will feed through to higher inflation as well. And of course, rates are already very low. I've taken a look at what negative rates would mean. I don't know if other people have as well, and they're not intuitive at all, actually. And so getting into that territory is something I'd want to avoid. So I think we've got to be ready to reduce rates for industry and post Brexit to help boost our exports. But maybe now is not just the right time for it. And so I'd be advocating a hold, but with a strong view for a future cut.
Okay, thank you very much. Let's talk to someone with a view on the general economy now. Karl Nendick from Active Chartered Financial Planners. Very interesting what Chris was saying there about negative interest rates. Have you any views on that? And what are your views on the general economy?
Certainly, Graham. So with ourselves, Active Chartered Financial Planners, we see clients across the range of both high net worth individuals, businesses, charities, etc. Taking your first point with regards to negative interest rates, I think it's a north-south divide on this one, really. Speaking to clients, certainly the bright lights of London and the investment bankers, I'm sure, would love negative interest rates. But for us in the northeast, I can only see it being a problem for us. Clearly, it's going to mean that banks are not going to have as much capital to be able to lend clients. We need that credit flow to continue as much as possible, especially when we have people and especially industry coming out of the COVID effect. And so, yes, negative interest rates, I would echo what Chris said there. I've had a look to what that would mean for us here. And I just can't see it being very helpful at this moment in time. With regards to the bigger picture in terms of what's happening with us and our clients, we've seen very, very robust in terms of how businesses have coped. Clearly, some have been affected rather badly, but on the whole, we've been impressed with how people have adapted using new technology. Certainly ourselves, we've been able to keep in touch with our clients by investing heavily into technology. We are seeing one or two clients that are wanting to wait and see what happens. Brexit is coming back and rearing its head and the nervousness is appearing again. But I think on the whole, people are trying to remain positive and look beyond this next set of negotiations. But I think from Active, we're pretty pleased, in fact, very pleased with how things have gone this year. If someone had told us where we were going to finish up by the end of December, around April, May time, we would have been highly delighted. So it has been a case of cutting costs for us and a lot of our connections. But the net result has been we've finished in a strong position, so long may that continue.
Thanks, Karl. And I'm going to bring in Nick Pope from Premier Tech Aqua. Nick, just remind us what you do and tell us how your sector of the economy is doing.
Yes, morning, Graham. Well, afternoon, Graham. My name's Nick Pope. I'm Managing Director of Premier Tech Water and Environment. We manufacture wastewater treatment tanks, chemical storage tanks, any form of tank to do with liquid, but particularly for wastewater treatment. And in a sense, obviously, that's classed as an essential industry. So whilst I think like most companies and manufacturers, the sort of the first sort of 4 to 6 weeks of shutdown back in March and April hit us quite badly. Once we kind of reconfigured ourselves to be able to work safely, we've found the rest of the year being quite strong, actually. Certainly on a par with last year, which is good. And again, I think as one of your previous contributors said, we'd have taken that back in April, May, when obviously the roof fell in, as it were. So I think overall we've had quite a strong performance. The area that's probably been suffered the most is the construction industrial sort of segment that we also operate in. Inquiries are as strong as ever from that sector, but converting into firm orders is quite slow, which I can only put down to a little bit of nervousness, shall we say, in terms of the future. But again, I think all the noises we're hearing from that sector are quite positive. So with a bit of luck, we should have quite a strong start to 2021.
Next, let's move on to Marie Rowe. Marie is from Beyond Housing, social housing provider. Many thousands of social housing projects they have around the Tees Valley and along the North Yorkshire coast, but also regular housing and development as well. Marie, how's your sector doing?
So I'm Director of Strategy and Change for Beyond Housing, and as Graham just said, Beyond Housing specialises in the delivery of social housing across Tees Valley and North Yorkshire. So we have about 15,000 homes, about 30,000 customers, and a range of services all the way from tenancy support and neighbourhood management, all the way through to independent living services and new build as well. So a lot of products, a lot of services on the go. And the pandemic this year, on the social housing sector, it has had a pretty big impact, and it has caused some seismic changes in the way that we approach things and deliver services in particular. We are seeing, and we do have some concerns for the future in terms of universal credit. We are expecting to see an increase. A large proportion of our customers who rent their homes from us are receiving benefits or in receipt of benefits, and we're expecting that potentially into the new year, as the winter package comes to its conclusion, we may well see more customers moving on to universal credit, which may actually impact on our income and which may actually impact on the sustainability of tenancies and communities. At the moment, social housing providers are concentrating a significant proportion of their efforts on preventing those things and assisting with those things. So we're doing our best to cover them off before they cause any problems for the organisation and for the sector, but it is something that we do need to be mindful of. As you pointed out before, Graham, part of our business plan is predicated on the development and sale of new homes, and I would concur with the report that one of the colleagues gave earlier in the session. We are seeing a mini boom. We were taken by surprise by it. We did expect it to drop off, so to speak, as a result of the pandemic, but we are seeing more interest in homes, more interest in different types of product of homes, so shared ownership and homes for outright sale. So that's something that we are working on. We are working alongside the government, who has issued a raft of new policies in relation to social housing and in relation to new housing construction, to see how we can really meet the needs and demands of our communities within the areas within which we operate. So there's some opportunities there. There's also some opportunities in terms of the green economy. So colleagues will have seen the government making, again, a raft of announcements last month in terms of how they hope to stimulate the economy in the local area, and greening of the economy was one of the things that they talked about. We're obviously looking to make our homes, new and existing, sustainable in the long term. So that's something we're working with the government on as a sector, and to understand their expectations and whether or not there will be funding available for that to inject some life into the local economy, as well as turn our houses into a sustainable home for the future. And finally, in relation to the original question in terms of interest rates in the economy, the social housing sector, and colleagues may not be aware of this, the social housing sector is funded by banks, building societies and pension funds. So we borrow to invest in our homes, predominantly in the sector. So we are kind of keeping a weather eye on the horizon with regard to how interest rates are going, to whether or not banks and building societies and pension funds are looking for good opportunities to invest in a safe bet sector, if you like. But we're also incredibly aware that should an austerity programme come about at some point next year, that might make our sector a little less attractive to those funders and to those lenders. So we're keeping an eye on whether or not there may be a credit crunch as a key risk to our sector as well. So they're the real headlines of what we're dealing with, Graham.
Thank you, Marie. Jonathan Willett from AON, big insurance firm. Jonathan, bit of headlines on where your clients are seeing the economy, and then finally we'll have Dan Williams in a moment.
Yeah, obviously we're predominantly commercial insurance brokers in the northeast, Graham. Effectively, our key has been diversity, because we've diversified across a number of sectors in the northeast. We're obviously seeing some businesses doing really well, such as shipping, haulage, recycling, anybody involved with the IT infrastructure. Even a lot of the local car garages have done extremely well, even though they've been closed for a period of time. And then on the other side, some of the smaller retail, the hospitality, the travel have obviously really struggled. Ourselves as a business in March, similar to Karl earlier on, we thought if we finished anywhere near we did the previous year, it would be an exceptionally good result. We will end up by being around about 10% down on revenue. However, we've saved more than that on expenses, with not incurring the travel and the hotels and everything related rounding company cars. So we'll probably be around about the same level as last year, which we view as an exceptional result. Slightly difficult place in the marketplace with insurance. Obviously, insurers do reinvest the premiums, and they're not getting the returns on reinvestment. So they are actually, some insurers are withdrawing from certain sectors, which is making the marketplace a lot more difficult, and they're actually reducing their exposure. So where we may have had an insurer write 100% of a risk, they're now reducing that to possibly 30 or 40% as a maximum. So we're having to find other insurers on the back of that, which is obviously increasing cost to certain clients' portfolio. The other factor that is ongoing is, you'll have seen it's well publicised regarding the FCA's involvement with the COVID claims, which is in the High Court of Justice and has gone to appeal. So that will have a major factor in January, when the outcome of that is known, and we'll have to see what impact that has on the marketplace.
Okay, well, thank you very much, Jonathan. I think quite a few people have a lot of opinions on that COVID one, but we'll see how it comes out. I've got Dan Williams, and then we'll be ending with Simon Hook before going to the wrap-up with Chris White. Dan from Latimer Hinks, you're doing a lot of deals and transactions this year, aren't you?
Yes, very much so. I think really sort of mirroring what people have already mentioned, really. I think at the beginning, so far as sort of professional services are concerned, we like everybody else, we look to sort of streamline, and there's been perhaps a bit of a silver lining so far as bringing new technologies and that sort of thing. But like Chris said, I think at the beginning, if you could have predicted sort of how things have perhaps turned out, then it's just incredible really, so far as obviously property transactions in the sort of more last couple of months, really fueled by obviously the stamp duty cuts, etc. And from a commercial point of view, the businesses that we're dealing with, renewing leases and all that sort of thing, it's obviously just been very, very busy from that point of view. But under difficult circumstances, circumstances in terms of the third parties that we're working with, in terms of staff being furloughed, and perhaps there being a sort of slowdown in the sort of a system in general, really, and perhaps a little bit of a backlog, but those things have certainly been improving. We're in the sort of position where we work with other professional advisors as well, and I think it's the same thing. Really, I think it's been unexpected, perhaps, just sort of how busy people have been, which is obviously a good thing. And I think perhaps in terms of predictability, it's very difficult to sort of see how things are going to sort of pan out in the new year, especially what with now coming on the corner with Brexit and what's going to happen there, and potentially what's going to happen from a budget point of view. But yes, I think in terms of how we found things, really, it's been slightly unexpected, I think, and just trying to, I guess, sort of take advantage of the current situation, prepare ourselves for next year, really.
Okay, thank you very much indeed. Let's finalise the list of our contributors with Simon Hook from Clive Owen LLP. You do a wide range of accounts for different sized businesses. What's your take on where we stand?
Yeah, thanks, Graham. Yes, here at Clive Owen, we provide accounts and tax advice for clients across all industries. And I must say, with the exception of the obvious one of the hospitality industry, most clients are having as good a year as last year. There was a lot of panic at the start of the year, but pleasingly, ourselves included, I think everyone has weathered the storm quite well and got through it. I think there's been some good help available, some good access to finance, and when we sit and look at clients' positions at the moment, cash flow is actually quite strong for them. They have got money in the bank, whether they borrowed it or got help. It must be said, though, that there has to be some caution. I think clients are very cautious at the minute of what's going to happen in 2021. I'll give you an example of one we saw last week. A significant sized engineering firm have decided to wait on a substantial bit of kit, new machines, because they just want to see what happens. So yes, they need it, but they're just waiting that little bit longer to press the button. So I think with, potential tax rates, potential interest rate increases, people are sitting on the money a bit longer, and I think that's, causing certain decisions to be made in business.
Okay. Simon, is there anything else you wanted to add?
No, that's it.
That's fine. We're going to go to our vote in a minute, and then we're going to talk to Chris White to summarise for us from Darlington Building Society. Before we have the vote, we've heard a lot of positivity from our business contributors today. But let's just look at the data. Consumer Price Index is 0.7%. Retail Price Index is 1.3%. Average earnings last month went up. Unemployment, although it's bad and it's worrying, it hasn't gone up as much as some commentators predicted, standing at 4.8%, 1.62 million. This is all data that was published in the Sunday Times this weekend. Retail sales on the year, surprisingly, are up 5.8%. Our trade balance and surplus, the deficit is up, so we're importing more than we're exporting. Gross domestic product has gone up on the last quarter by 15% when you add everything in, but is down by 9.6% on the year. And the budget deficit, the amount the government is borrowing to pay for public spending, is horrendous. So far, the year to date, £214 billion. On that basis, would our contributors, if they were on the real MPC, would they put interest rates up, down, or leave them the same? Let's go first of all by show of hands for anyone on the panel who would put interest rates up. 0. Let's go by show of hands for anyone on the panel who would reduce interest rates further. 0. Let's go by show of hands for people who would keep interest rates as they are. Unanimity. Unanimity indeed. Well, thank you very much, everyone. Let's wrap up with a few words from Chris White of Darlington Building Society. Your savers won't be very happy with that.
Well, I guess we've had a historic low for savers for quite some time now, Graham, and I think it would be brilliant if we could find ourselves in an environment where interest rates would come up and we'd be able to kind of pass some of that interest on to savers. It's been a very long time for them in low interest rate environments. I guess what we've seen around the table is while there is some positivity in some areas, we've still got a lot of headwinds ahead of us. We've talked about coronavirus and the lasting impact of that and the long-term scarring that will have on our industries, as it were. I think, Graham, you kind of showed some of the stats that really do kind of bring that out. And then obviously we've got Brexit looming as well, and particularly, I guess, more recently over the last few days, the potential for a no deal obviously coming up the ranks as well. So I think that whilst it would be lovely, clearly, to be able to kind of get to an environment where interest rates were higher and savers would be certainly one of the big beneficiaries of that. I think obviously the current economic climate, as we've seen by a unanimous vote, I think probably doesn't warrant an increase at the moment, and I guess that would be my expectation of how the real MPC would vote later in the week as well. But I guess we shall see.
Thank you, Chris, and thank you for joining us. There'll be another video Shadow MPC in a couple of months, but watch the Northern Echo every month because we poll our business contributors and find out what they think interest rates should be on a monthly basis.